Hello and welcome to this introduction to interest rates brought to you by Passing Score, where you can get more help on your exam prep at passingscorefinance.com. In this video, we'll be going over some concepts around interest rates. But most simply, an interest rate is just the price that we have to pay in order to borrow money, whether it's in the form of a bank loan, a bond issuance, or some other vehicle. It's what we have to provide to motivate somebody to invest in our debt offering rather than any other investment they could possibly make or spending they could do with that same money. And this ties right into the concept of an opportunity cost, which is all those other alternatives. When we choose a specific course of action or specific investment, we give up the ability to do anything else with that same money. And this is important to understand the idea of a required rate of return, which is the minimum that we're going to have to pay in order to attract people to our investments. A required rate of return is made up of several components, which we'll take a look at here, starting with the risk-free rate. This is an investment with no credit risk, usually represented by U.S. government debt issuances. The real risk-free rate is that market treasury return less any expected inflation. And that inflation expectation can fluctuate over time and obscure the real risk-free rate. In economic theory, a risk-free rate is a return that would cause somebody to defer current consumption in order to obtain that return in the future. Now, only the government can borrow at the risk-free rate. Everybody else has to layer on several premiums, higher interest rates represented by these four components. We saw the inflation premium, which makes up for lost purchasing power, but we also have a default risk. The risk, however improbable, that someone will not be able to make up their principal and interest payments on time. There's also a liquidity premium, which compensates someone for the loss of availability of their cash, and a maturity premium, which is the increased risk over time that somebody will not be able to pay, which can be very minimal for a 7-day investment, but significant out to 5 and 10 years, for example. Once we have these additional components, we can come up with our required rate of return. We have a real risk-free rate plus inflation, default, liquidity, and maturity premiums. Together, this required rate of return is also known as the discount rate or opportunity cost. And this is the rate that's used to discount future investments or capital investments to find out if there's a good return on that investment. It has to make up for all these premiums and the risk-free rates. This is usually designated as a lowercase r in the formulas. Now there's another way to look at returns, which is the nominal return versus a real return, and the difference is the inflation in between. Our nominal return is the amount that's stated. Our real return is the amount that of purchasing power adjusted return of our investment. And let's take a look at an example of this to get a better idea. We have a $10,000 investment for 1 year, and we want a 2% return on our investment. If we settle for 2%, inflation might be 3% over the course of this year, so that your real return is actually negative 1%. You've had a purchasing power loss of $100. You can't buy the same amount of things at the end of the year that you could at the start of the year. Now, if we want a real 2% return, we're going to have to incorporate inflation into our required rate of return to get a $500 amount. This results in a real return of 2% and a purchasing power gain of $200, which we were targeting. Now, inflation is an important component, but the interest rate markets actually move by several other motivating factors as well. And this includes the economic outlook, trade balances, exchange rates, capital flows, the consensus of the market as to where interest rates will go, and of course, government policies and restrictions. All of these can significantly influence interest rate markets. Now, if you're looking at this to prepare for an exam, there's a few other points here. Remember that the required rate of return is for any kind of asset. This can be stocks, bonds, capital projects, new products. All of these can be discounted using a required rate of return, as we saw above. Many times in exams, they will ask you to put together the components, the premiums, along with the risk-free rate to get the required rate of return. And just don't be fooled by fake premiums or components that really don't belong in there or are stated twice in different ways. Well, that's it for our introduction to interest rates. If you have any questions, please feel free to email me at john@passingscorefinance.com. And thanks for listening.